Hello, and welcome to this month's episode of Capital Markets View. I hope you all had a good summer, and I'm very happy to say, in London at least, we have the tail end of an Indian summer. Some very nice late September days before we go autumnal at the end of the week. Taryn, how are you? Did you manage to get a break over summer?
I did. I went to Surrey.
Oh, exotic stockbroker belt.
Yes. My in-laws. My
Oh,
in-laws. I
okay.
never thought I'd be happier to go to my in-laws than I was.
So my in-laws are in Australia, so it's a little bit more difficult at the moment.
It's good to have a change of scenery this
Yeah.
year.
Oh, yeah. Right. Okay. So let's go straight into our first slide, which is European new issuance leveraged finance volume. It's monthly this year versus last year, and you know what? Incredibly, institutional loans. I mean, it's August, traditional summer lull, but actually, institutional loans for August this year were above August last year. That's pretty good going, actually, considering we're in the middle of a
Yeah.
pandemic.
Yeah, I just looked at the averages, and over the last 5 years, we had an average of 1 billion euros in August. So we were actually slightly above at 2.1 billion. So I guess people were making up for a bit of lost time. So it was a little better than the usual quiet August. And I guess since we've been back, September's actually been quite busy already. I checked this morning; we've got 3.8 billion issued in September already, because I'm starting to look at quarterly volumes. So the market's back open, and we have some deals out, and I think the market's expecting a bit more opportunistic transactions that might boost supply soon. Even some talk of dividend recaps. I'm not sure, particularly as there's been a bit of risk off in the last couple of days.
So I've this morning I watched the LMA's heads of syndication panel, and interestingly, Charlotte Conlan of BNP Paribas said that they actually had a relatively busy late spring and summer clearing their existing underwriting positions, so it wasn't quiet. Interestingly, on this graph though, the high yield bond market is sorry, I'm pointing at the slide. The high yield bond market's pretty go. I mean, way more than the loan market, I have to say.
Yeah, I mean the bond market. When you look at all the issuance that we've had this year, actually the bond market is pushing leverage finance volumes ahead of where we were this time last year. When you look at the September volumes, I know that we're actually just looking at August right now, but I mean that market really has been so busy this year, and we didn't have any issuance in August, but we have had a lot of issuance throughout the year, and there's a big pipeline at the moment in terms of new transactions. I think that the iTrax came in last week below 300 for the first time since February. Yesterday, the 21st, it widened out again as there were more fears of lockdown restrictions. But Maxita last week, they did a deal. That was really popular in the market. So there's a lot of demand at the moment for high yield bonds, particularly a lot of double Bs in the pipeline expected.
Wow, I wonder if that's because the government liquidity in the market is driving investment grade pricing down in bonds, so people are having to dip into double Bs if you're a big fund manager. I guess that must be the logic, I guess.
Yeah, I think a lot of the activity this year in loans and bonds is being driven by the technical factors of liquidity, government intervention. So, there is a lot of demand for both products, but in particular bonds, like you say.
Yeah, and people dipping into that double B space because they can't find what they want in the triple B space. And of course, because of downgrades, some of the names that people may still believe in being double B now, not triple B. Okay, let's zip to the next slide, which is new issuance volume sponsor versus non-sponsor. Sponsored volume's holding up pretty good. I don't know if that's because actually this is a year-on-year graph, and so actually you've got some big things like Cobham and ThyssenKrupp in there, but looks okay, I have to say.
Yeah, I think I think the reason mostly that sponsored volume has held up is because we had really, really busy January and February.
Yeah.
Um, you know, you have to go back a couple of years to see busier months in the market in terms of sponsor driven issuance. I think, in terms of new M&A going forward, it's looking a little bit less hopeful. Although that being said, there is activity. Final bids for ASDA were due last week. And just this week, we had two new deals in the forward calendar. So it's not a huge deal, but this French nursery, Babalu, its buyout. We also have Iliad's takeover of Play that's being taken to the private market. In the pipeline, we've got Elitech, the AA, the Philips Appliances division, Unilever's tea businesses. So there is, I think there is a pipeline, but everything just seems to be taking a lot longer. A couple of the buyouts that were announced, before COVID haven't come through. So, it's just things are taking a bit longer this year, but there is quite a bit of sponsored activity.
Yeah, and I wonder if those pre-COVID ones are not coming through because that's a pricing issue at old pricing.
Mm.
Okie dokie. Next slide. This is actually alludes to what we said back earlier. So this is the leverage loan versus the high yield market. And we've covered, I think, high yield
Yeah.
and how it's pretty good at the moment. So the next slide is pricing. Single B primary spread and yield to maturity. And it's in this slide, it's kind of flattened out a bit.
Yeah.
Up at around, let's have a look. We're talking at about
It's about
5% for a term loan B.
Yeah, so this is August data, so it's a bit skewed by the fact that we haven't had a lot of it's 3 month ending August. We haven't had a lot of deals in August, so I do think that we're going to see it tick lower when we do
Yes.
the quarter end data in
Yes.
September.
Yeah.
I've been talking to a couple investors, and they were saying that pricing really continues to come in. It deals unless it's say a new LBO new to the market, you're going to have to pay up for that. But anyone who is a borrower who is a well-known borrower and the investors want to stay in the deal, then they're going to subscribe to say these. We're seeing a lot of add-ons, a lot of extensions of maturities. So it still is quite a borrower-friendly market, which is a surprise, seeing as the year that we've had.
Yeah, I'm doing the rounds of debt syndicate desks at the moment, actually talking to them about ESG. But as we talk, we ask them all kinds of questions about how the market's going, and they are talking about leverage finance pricing coming in a little bit. And I think that's a technical function of not as much volume as people would like, combined with not a bad CLO market at the moment. I have to say the volumes may be down, but the number of issuances is reasonable, and we'll talk about that in a little while. So yeah, you're right. I think this is when we get to see September figures for leverage finance and October. I think you're going to see leverage finance pricing coming in.
Yeah.
Um, okay, and we're on to the monthly CLO volume figures. So you know what? I mean, the last time I checked the figures, and I think there's been a few more deals recently, but we were on about 40 deals year to date. At middle of last week, I checked the figures compared with 49
Mhm.
deals year to date last year. So, in terms of number of deals, not bad, but slightly
Yeah.
smaller deals as people pushed warehouses out into the market. There has been, I think, at least one drive by where they just did a quick deal.
Yeah.
So numbers not bad, volumes not as large as before. But equally, I'm just back from a holiday, and whilst I was away, 5 CLO mandates popped in my inbox.
Mm.
So it's the CLO market in Europe is doing pretty good.
Yeah, I would say to your point, I did check and we're 36% behind last year in terms of the volume. So not the volume, not the number, but the
Yeah,
amount of debt
yeah,
being issued. So you're right, and these deals were characterized by lower leverage, smaller deals. But as you said, our CLO journalist Michael, he's hearing there are 8 to 10 warehouses building that are from the COVID era
yes,
CLOs,
yes.
uh,
New
and
warehouses being opened. Yes,
Yeah, and also, some of the analysts in the market who forecast CLO issuance have been revising, and so potentially we could see 6.8 billion of issuance come through for the remainder of the year. So I think everyone's very positive. And when you look at the arbitrage, which is the next slide, um, I think the big news in the CLO market over the past few days has been the pricing on some of these
Oh
AAAs.
my goodness, yes.
Yeah, BlackRock priced at the AAA is at 120, and Fair Oaks followed at 125. And there's a deal being marketed for CVC Cordatus, which is 120 to 125. And if we compare that with pre-summer, the post COVID-19 tight was 145 basis points. So it's, AAAs have really come in.
Yeah, yeah. And so what that means is the technicals look pretty good. I mean, I think the arbitrage, if you're a CLO manager, and if you just look at those highlight figures of where loan pricing is and where AAA pricing is, looked pretty good. I think the problem that CLO managers will have going forward is getting loan supply. And I
Mhm.
spoke just before I went on holiday to one major CLO manager, and he said he's not planning on doing anything until Q1 next year. And the big restraint on him is getting enough loans into his warehouse. But then equally, you've just said 6.8 billion of potential CLO issuance that your journalist figured out. And I have to say, like I said, all these mandates that came into my inbox while I was away. So actually, I think the CLO market is chugging along pretty good.
Yeah,
Um,
and I think there's a bit of chicken and egg. If, as you said, if there's more CLO issuance, um,
yes.
then the deals may come. I do think also just to mention that secondary is a bit of an issue because we've seen such an improvement in secondary prices. So, you can't get as good of that arbitrage with the secondary prices that you could before moving them into your warehouse. So that is also an impediment, but hopefully there will be new issuance to put in the warehouses. Yeah, but I think, yeah, there is definitely a shift in the past couple of months.
Yeah. Okay. And actually, this next slide is the CLO weighted average cost of capital, the WACC versus term loan B, and that just reinforces what we were saying about um, uh, the arbitrage and what CLOs are paying across their entire stack, the WACC. So the ARB looks pretty good if you can get hold of the paper.
Yeah.
And then we're on to number of distressed credits in European leveraged finance market. So just to give this some context, we are now seeing the speculative grade 12-month default rate at 3.8. The running average is typically 3.3. And we are predicting by the middle of next year, the default rate might be around 8.5% on an optimistic basis and 11.5% on a pessimistic basis. Still, I have to say, compares this sounds awful. Compares favourably to the last crisis.
Hmm.
It hasn't gone off the scale. It's we're not predicting 20-25% default rate. So yeah, well, I mean, and this slide shows well, of not surprisingly, year to date August distress credits versus last year up significantly.
Yeah. Yeah, no, and those are the ratings numbers and the ratings forecast at LCD. We have it's actually very similar. I think we're at 3.3% by number of credits in the LE index for the last
Okay.
12 months. So the numbers are pretty close. Yeah, I mean, Isabel published a topical piece on distress last week, and I think it looks at the fact that this has been a market value collapse, not really a credit crisis, talking about the fact that we've seen secondary recovery. And I did look at the LE index, and we actually do finally have some credits trading above par. In the
Wow.
in the index, it's gone up to 0.24% in August, and that's the first time the measure has been above zero at month end since March. So, and her piece also just looks at how it's been contained to certain sectors like
Yeah.
leisure, home
Yeah.
products, aerospace, hotel, and obviously we've had government support as well. But I think the question remains, is this kicking the can down the road because triple C's have risen? Um, and we still see 8 times the number of downgrades to upgrades in the alley on a rolling three month basis. So there are credit issues out there. Um,
And you know
but
what the
yeah.
heads of syndication this morning said when they talked about new leverage volume? In certain sectors was the caveat that they put on.
Mhm.
It-
Definitely.
yeah. Okay. Okay. Next slide. Number of financial covenant amendment requests. Not surprisingly, relatively speaking, gone through the roof. Um, uh, I do remember as the crisis unfolded, people tried to do a kind of an EBITDA look back on, it not using COVID figures, but I know that the market pushed back heavily against that.
Mm-mm.
But it's not a surprise that there have been other covenant requests coming through.
Yeah, I mean, I think there's not much more to say about this other than the fact that, in particularly, we've seen this as companies need to access liquidity, just because of the COVID lockdowns.
Yeah, yeah. No, absolutely. Okay, and then the last slide with stats on is the loan index, and you're comparing here the LE, the European Leverage Loan Index,
Mhm.
with the S&P LSTA. Is the LLI? Is that the S&P LSTA index, Taryn?
Yes, it is.
And it
Yeah,
shows
I mean,
basically it shows North America versus Europe and how we're relatively in step with each other.
Yeah, I mean, I just wanted to put this in because David recently wrote a topical that looked at leverage credit in Europe compared to other markets, and I thought it was interesting because U.S. has outperformed Europe, and mainly that's technical with central bank intervention, but also the U.S. market is just bigger with more depth and a larger cohort of double B borrowers. They also have mutual fund flows that we don't see in Europe.
Yeah.
But yeah, it's just an interesting piece of research. Looks at the different markets, equities, high yield bonds compared to loans in both regions.
Yeah, and then, you know what? America hasn't outperformed us that much, looking at where the graphs are here.
Yeah,
Um, but yeah, it's a different market, particularly with the mutual funds buying loans, which we just don't have here.
yeah.
Cool. And our last slide is a particularly lovely autumnal photo. Lots
The
of different.
most important slide in the
Yeah,
deck.
yeah, absolutely. Lots of different shades of orange and yellow. And actually, as I look out into my garden, I have a lovely acer, and it is just beginning to turn from green to some of the leaves kind of edging red. Anybody would think I was presenting Countryfile rather than Capital Markets View. So I hope everybody is enjoying. Actually, by the time this goes out, probably I hope you enjoyed the last few days of what was a very nice summer period. And now we are truly going into autumn. If you guys have any, or guys and girls have any questions for Taryn or I, questions about research, questions about where to find it, things that you'd like us to actually talk about or write about, please feel free to send us an email or give us a call. And that's everything. Thank you very much, Taryn.
Thank you.